We've got more positive housing news, a Eurozone banking deal, and more importantly, what would the world look like without Fannie Mae and Freddie Mac? You're in the right place, folks, because this is where the money is.
One of the most important steps we can take in ending too big to fail institutions is to remove the permanent taxpayer-backed government guarantee of Fannie and Freddie. For far too long, Fannie and Freddie have been where Wall Street and foreign banks go to offload their financial risk on Main Street taxpayers.
David, we were just listening to Jeb Hensarling, the chairman of the House Financial Services Committee, giving his view on Fannie Mae and Freddie Mac and their relationship to Wall Street. Has this just been an issue of Wall Street offloading risk onto Fannie Mae and Freddie Mac?
I don't think so, especially when you step back and look, why do Freddie and Fannie even exist? I think that's a question that we should address. Why do they exist? They exist to provide liquidity to the housing market. And we don't want to get all wonky, liquidity, housing market, all that stuff. So why do they exist? They take loans off bank balance sheets. That's where he talks about Wall Street there. They package those and back them with basically insurance. They're essentially insurance companies insuring these securities that they issue, and then give that out into the marketplace to investors like mortgage REITs, banks, keep them on their balance sheet. So they do exist for a pretty important reason to provide liquidity to the housing market. So any changes to their structure will impact that. So going forward, it's going to be very important to see what do they do, how do they change these institutions.
Look, I'm going to make this really simple. I don't think the problem with Fannie Mae and Freddie Mac ever had anything to do with Wall Street just looking at it as a way to offload risk. I think the big problem was this lack of clarity, a lack of clarity of what the government really has to do with Fannie Mae and Freddie Mac. In the past, Fannie and Freddie and the government basically both said, well, the government doesn't really back Fannie Mae and Freddie Mac, and yet everybody thought it did. And we found out that it was going to in the end. And so what you ended up happening was you had these companies able to take on dizzying amounts of leverage. I mean, if you thought that there was a lot of leverage on Wall Street, Fannie Mae and Freddie Mac put them to shame. And still today, the leverage is so ridiculously high. These were very risky institutions because everybody knew that the government was going to step in and take that place as the sort of the Fannie Mae, Freddie Mac savior of last resort. I think the solution will come from getting more clarity around what role the government actually plays in the housing market and not this kind of sort of gray area that we've had. Now, when we think about the potential of Fannie Mae and Freddie Mac going away, a bunch of the mortgage REITs out there. Now, a mortgage REIT, for those that don't know, it's a real estate investment trust that primarily buys and sells mortgage-backed securities. And there are a bunch of these mortgage REITs that all they do is trade in agency-backed, Fannie Mae, Freddie Mac-backed mortgage-backed securities. Annaly Capital, a big example of that. American Capital Agency, a big example of that. What happens to these companies if Fannie Mae and Freddie Mac go away?
If they didn't exist anymore, they would obviously have to change what their investment structure is. You mentioned American Capital. They only invest in American agency-backed, mortgage-backed securities there. And Annaly, on the other hand, I think theirs is around 75%. The other 25%, they can invest in other mortgage-backed securities and other real estate ventures. So if these institutions did completely go away, they could potentially pivot to a new area. Same with a company like Two Harbors. They're not only invested in agency MBS. They do have their hand in other areas. So if they went away, I would look towards a company like Annaly, a company like Two Harbors. I think they could pivot a little easier than an agency-only shop.
Yeah, I agree with what you're saying. I think the special sauce with a mortgage REIT is the management team. This isn't a business where you've got a product that's going to keep customers coming back again and again and again. You've got a management team and you've got investors there that are creating the value in these companies. So it's still going to be about who's the management, who are the investors. Annaly, I think, has some of the best management in the sector. They've got they brought in Crexus. They bought Crexus, sort of a sister company, which is not agency-backed paper. They've got another sister company, Chimera, which is not agency-backed paper, which is non-agency-backed paper, and it's the same, basically the same investment team that's over there managing Chimera. So they've got experience in that. American Capital Agency, on the other hand, Doug Kane, who's the CEO and principal investor over there, he came up through Freddie Mac. So, you know, I'd be a little bit more concerned about a pivot to non-agency paper there. Like you said, Two Harbors already has a mix of assets. They've got sort of a hedge fund background there, and so I would be pretty confident about them making the pivot as well. Another group of businesses that would have to make a pivot without Fannie Mae and Freddie Mac, banks. So what happens to banks? Is this a big concern for banking investors?
Well, I think it hits the banks in two separate ways. When I said they provide liquidity to the mortgage market, so this impacts a Wells Fargo, JP Morgan. They're the two biggest originators. So their loans that they're originating, they're selling to Fannie Mae and Freddie Mac. I think Fannie Mae and Freddie Mac own around 90% of the new mortgage market share right now. So if that went away, obviously there might not be the same demand to get those mortgages off their books and generate those fees. The other place that hits them is on their books. These banks hold a lot of agency mortgage-backed securities on their books. If we look at Bank of America, they have something they classify in their balance sheet as global excess liquidity sources. And without getting too wonky and putting people to sleep, they describe that as assets with high quality, liquid, and unencumbered, which they can quickly obtain cash for. So if we look at Bank of America specifically, they have $372 billion at the end of 2012 in this group that they classify as that. 73% is agency mortgage-backed securities or agency debt that they hold. So these institutions are very important to the liquidity of these banks. So if those were to go away, you could potentially argue that those are more risky securities now.
Sure, and I think if I'm boiling down what you're saying here, I think on the one hand, what bank investors are going to be looking at is on the income statement, there will be a potential decline in fees as there's less opportunity to originate mortgages, sell them off to somebody else, and collect that fee. There will still be ways for banks to sell off the mortgages and get the fees from mortgage origination, but it may not be as great as it is currently with Fannie and Freddie there. And the other issue is, where do banks invest their capital that they need to be highly liquid, very safe. And right now, agency-backed, Fannie-backed, Freddie-backed, mortgage-backed securities are very highly liquid, looked at as very safe, basically quasi or maybe actual government-backed debt. So I think the pivot there is either to go to very high-quality corporates or to go to actual types of government debt. You could look overseas as well to some of the higher credit quality sovereigns overseas. Now, pivoting away from Fannie Mae and Freddie Mac, getting a little bit, but staying in the housing market here, we've got news out of KB Home, some more good housing numbers from them after Lennar posted a great quarter earlier this week. What were you looking at in this report? The
number that caught my eye was the average selling price of a KB Home year over year. It was up 25%. Obviously,
housing bubble.
I don't think quite a housing bubble.
It's a housing bubble, David.
I mean, KB Home, they're still down from their peaks, obviously, from 2005, 2006. Over the past year, it's up like 140% in the stock price, and today it's up around 3%. So I was encouraged to see that home prices were up for KB Home, and you mentioned Lennar. A couple of these two together, it's been a pretty good week for them.
Yep, and what I was looking at in the KB report, just like you said, I noticed those average selling prices up 25% year over year. The number of homes in KB's backlog, so the homes that they're prepared, that they've got contracts basically to sell, up 6% year over year. So you take 6% gain in the number of homes they have in their backlog, 25% gain in the average selling price. That's pretty good for KB. And also, I should probably mention here that we also heard from the National Association of Realtors today, pending home sales, their pending home sales index up 12% year over year. So again, this is all of that positive momentum in the housing market. And we saw in May, so some of these numbers we're starting to see some May numbers. In May, we had already started to see interest rates rise. That rise has continued through June. So it'll be interesting to see, as we see the rest of May's numbers, as we start to see June's numbers, look to see whether the higher rates are impacting the recovery of the housing market, both in terms of prices and in terms of sales volume.
Absolutely.
And closing out here, we had a deal in the Eurozone that basically, comes to an agreement on what to do about failing banks. This has been a big problem for the European Union in general. You've got all of these banks that have been very ill, lots of bad assets, and the losses to a large extent initially were pushed on to taxpayers. And when you don't have, when it's not like the United States where it's we're a integrated country of many states. These are individual countries here, and so Germany has gotten pretty sick of bailing out everybody else's hurting banks. So essentially what this does is the first 8% of losses are put on the liabilities of the bank are put back on shareholders, are put on bondholders, and are put on wealthy depositors, that is depositors that have roughly 132,000-ish in deposits. That's converting, I think it was 100,000 euros. So those three groups will absorb the first big chunk of losses until it goes to taxpayers or anybody else. I think that this is it's a great solution. You know, when we look back at the troubles that the U.S. banks ran into, there were losses that were put back on shareholders from the perspective that, you know, it's easy to, you know, we think about Bank of America and Citigroup, both stocks are up big over the past couple of years. Bank of America's stock is still down 40% from mid-year 2008. Citigroup stock down 73%.
Jeez.
From mid-year 2008, and obviously taxpayers stepped in. The taxpayers have been paid back, and they've been paid back with a profit, so that was a good outcome. But what about bondholders? What about the people that are financing the banks, who are lending money to the banks and allowing them to get the leverage that they got during the financial crisis? They came out smelling like roses.
Right.
And so, you know, I think that there's maybe something to be learned for U.S. regulators from what the European regulators are coming out with. That said, there's still a lot of craziness going on over in Europe, and they've got a long way to go.
Right.
And that's all I've got.